Welcome to NASDAQ Trade Talks for special Cyber Monday coverage. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me at the market site in Times Square, we have Pierre Debbas with Romer Debbas LLP. We're going to take a look at how the digital world is making it really tough for the retail real estate market. And Pierre, great to have you back with us as always. But when you think about brick and mortar versus what's happening with online, what about the retail real estate market itself, those REITs that we discussed, these iconic buildings in New York, like Barney's, for example? What happens to all them?
I think you're seeing correction now in terms of what the future of retail real estate is going to be. What the ultimate outcome is, nobody knows at the moment, and I think will be one of the biggest storylines going into next year. Because every year that's gone by over the last decade, online shopping has had a negative impact on retail, and it's only getting worse and worse by the year. And you brought up Barney's, which is a tremendous example, because Barney's, like a number of other national retailers, Forever 21, Gymboree, filed bankruptcy. And if you look at actually Barney's actual physical retail space, it's about 10 stories of space on Madison Avenue and 60th Street. Who's going to fill that up? Are the chances of a single tenant coming in there, taking over the space likely? I don't think so at all. So it's going to be a great example for how retail will adjust to the realities of today's market in what will happen at Barney's. Could they subdivide it into a different retail tenant on each space and just have smaller retail spaces? But then what's your targeted retail space? I think that's the biggest question mark, is that where is the demand going to come from for all the retail space? What type of businesses will replace clothing stores and products as opposed to where all the demand's going online for?
Yeah, I mean, who can afford Barney's retail space anyway?
Right.
I mean, that's 10 stories in one of the most iconic spots in Manhattan. Do you think that, let's look at the Dream Mall, for example, in New Jersey, where 50% of it is all about experiences and a way to bring community together. Perhaps traditional retail isn't the answer, and more of a mix or an experience kind of structure might be what's called for.
Yeah, that's certainly the future of what's going to happen to a lot of these spaces. The question is, will that be able to take over all the supply that we have? You know, right now in New York City, from 2007 to 2017, the amount of available retail space has doubled. We have 11 million square feet of available retail space. That's as of 2017. We don't know what it is as of today. I'm sure it's higher. Now, when you talk about service businesses and experiences, you take gyms. You're having now, there's all these new classes that are popping up with different types of gyms, and people don't go to traditional gym anymore. They pay per class. That's filled up a lot of retail space. Then you're going to talk about services, dry cleaners, hair and nails, things of that nature. But will that be enough for all the vacancies that we have? That's going to be a huge question mark going into.
Is part of it, it's just expensive, and it's New York, and it's New Jersey. I feel as a landlord, and you obviously know this better than I do, I'd rather charge less rent and at least have the space filled than, 11 million square feet is just getting wasted. Yeah,
I mean, that's going to be the question in terms of, can these businesses that we're describing, do the economics work out where they can afford the rent that the other retailers were paying? If you take, for instance, an experience, companies of whatever the case may be, just take the experience industry, can they occupy all Barney's at the price per foot that Barney's is paying?
What do you think they were probably paying?
Oh, God, I couldn't even imagine. I'd have to do a little bit of research. I would say it's north of $100 a foot easily.
Oh, wow.
A very high, and well north of that, actually. And then it brings you to another point in terms of now lowering rents. Lowering rents is a logistic answer to this. If you lower rents, you will create demand. The problem is that landlords don't have the unilateral ability to just reduce rents. The majority of landlords have loans on their properties. And in most commercial loan documents, there's going to be a floor that's stipulated in documents for what the landlord can accept for rent. And the reason the banks do this is that they want to preserve a certain amount of cash flow and preserve over time, you're paying down debt service, building up equity, and if they're preserving cash flow, the property value has a higher likelihood of appreciating. So the loan becomes more conservative from them from a loan to value perspective. Now, the landlord has to go get the bank's consent in order to do this. Logistically speaking, banks will want to agree to it because they're not going to want to have loans defaulting due to unrealistic rent demand or rent requirements. But like any cycle and anything involving a change in the market, that will take a couple years to iron out. I think next year you'll start seeing a lot of landlords that are actually, banks are consenting to these rent reductions. And the question is going to be, how much? If you look at some of the prime real estate in New York City, you take Broadway and Soho, and you take Madison Avenue and the Upper East Side, which are two of the most iconic retail strips in the world. They had rent declines of 15 and 17% in the last year.
Oh, that's high.
That's a lot, yeah, that's extremely high. So I think that you'll see that trend even more, but what will be the percentage that banks consent to? It's going to be, something that I'm eagerly waiting to see.
Who's faring worse, Manhattan real estate or these large REIT conglomerates with shopping malls across America?
Well, the shopping malls, you know, the REITs across the country, the REITs sector is doing all right because the interest rates are still so low. So they're still having good returns. I think the Manhattan shopping sector, when you look around, you know, I was getting at a coffee store yesterday reading the paper, and I looked across the street at every retail space I saw, and it was restaurant, gym class, restaurant, vacant. And it's like, how many restaurants can you have?
We like to eat and work out in Manhattan.
We do, which is kind of counterintuitive, I guess. But at the same token, you know, when you're going to focus on so heavily on the restaurant industry, what's the average lifespan of a restaurant? Average lifespan, if you read, statistics vary on restaurants, but for the most part, national and independent restaurants all fail within 5 years. And if you look at just solely independent restaurants, that number's drastically lower. I mean, I think in New York City, depending where you're reading, it's between 1 to 2.5 years is an average lifespan. So when you're a landlord, you're issuing leases of between 10 to 15 years. And banks are underwriting loans on that cash flow with the increases that are provided for in the leases. Now, if you're having a high-risk tenant and such a concentration of high-risk tenants in restaurants, what's going to lead for the commercial lending market? Are banks going to start devaluing real estate significantly? A lot of these loans were, you know, we've been in a low interest rate environment for a decade. A lot of these loans were taken out in the last 10 years and come up for renewal in the next, 1 to 3 years. It'll be interesting to see how banks, adjust the valuation of real estate based on this issue.
All right, so interesting. Thanks for joining us as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.